What happens when fiscal and monetary policies fail to coordinate? Imagine trying to steer a boat with two people pulling in opposite directions. That's what happens when fiscal and monetary policies don't work together. When these policies clash, their efforts to control inflation and keep the economy stable can fall apart. This can lead to unpredictable swings in prices and economic health. Fiscal policy is about government decisions on how much to spend and how much to tax. It influences how much money is circulating in the economy. Monetary policy, on the other hand, is managed by central banks. They adjust interest rates and control the amount of money in circulation. Both policies aim to keep inflation in check, but if they act against each other, problems arise. For example, if the government decides to spend more money or cut taxes to boost the economy, but the central bank raises interest rates to fight inflation, these actions cancel each other out. This confusion can make markets uncertain and slow down economic growth. It can also cause inflation expectations to become unstable, making inflation harder to control over time. When policies are not aligned, responding to sudden shocks becomes more difficult. If energy prices spike or supply chains break down, uncoordinated policies can worsen the situation. The central bank might keep raising interest rates, which can slow down growth and increase unemployment. Meanwhile, the government might not provide enough targeted help to those hit hardest by rising prices. Another problem is that uncoordinated policies can weaken long-term price stability. If the government runs large deficits and the central bank tightens money too much, growth can slow down too much. Conversely, if the central bank tolerates higher inflation without fiscal discipline, inflation expectations can become unanchored. This can lead to persistent inflation, which is hard to bring down later. For inflation to be controlled effectively, both fiscal and monetary authorities need to work together. They can design strategies that address the root causes of inflation. For example, the government can support essential prices like food and energy through targeted fiscal measures. The central bank can then use interest rate adjustments to support these efforts. Coordination also helps in investing for the future. Funding infrastructure projects or green initiatives can boost economic resilience and help stabilize prices over time. When policies are aligned, it becomes easier to respond to economic challenges and keep inflation under control. If fiscal and monetary policies don't coordinate, inflation control becomes less effective. Economic volatility increases, and social hardships can grow. Having a clear policy framework that aligns both sides is key to managing inflation well and ensuring long-term economic health.